Hi, so we've been talking about the cost of capital and WACC. Let's finally find out what that means and how we calculate it when it's unknown. So what types of long-term capital do firms use? There's typically three pieces of capital: long-term debt, preferred stock, and common equity. Sometimes firms use permanent short-term debt, which you would include in the WACC calculation, but most likely it's temporary and is not part of the capital structure. Capital components are sources of funding that come from investors. Therefore, these other short-term sources of funding do not come from investors and are not included in the calculation of the cost of capital. However, we do consider these when we're calculating the cash flows of a project. There's a difference between before tax versus after tax capital costs. We focus on the after tax costs of debt only. Investors provide capital to the organization and require return on their investment commensurate with the risk of the capital. The returns to the investors are a cost to the company. That's why WACC is a cost of capital. Interest expense can be deducted for tax purposes. Therefore, the cost of debt is an after-tax cost of capital. Remember, last chapter we talked about free cash flows. A free cash flow is the cash flow that's available for distribution to investors. Therefore, free cash flow must provide an overall rate of return sufficient to compensate investors for their risk. That's why the return should be a weighted average of the capital components' required returns. Let's see how this works. When we're looking at the cost of capital, it's used to make a decision which involves raising and investing new capital. Therefore, we should focus on marginal costs. A marginal cost is the cost of issuing new capital, so it's the current market rates, not the book value. There's three different methods to calculating the cost of capital. Ask an investment banker what the coupon rate would be on new debt, find the bond rating for the company and use the yield on other bonds with a similar rating, or find the yield on the company's debt if it has any. What does that mean? Let's look at an example. Here we have a 15-year, 12% semi-annual bond that sells for $1,153.72. We can use our rate formula that we've learned about in the past to calculate the current rate on that bond. Like I talked about before, interest is tax deductible. Therefore, we would look at the after-tax cost of debt, which is the rate times 1 minus the tax rate. In this case, it would be 6%. Flotation costs are ignored in this example, but we'll talk about those in a little bit. Now let's look at how we calculate the cost of preferred stock. You guys might recognize this formula from Chapter 7. Rate is on the preferred stock is equal to the dividend on the preferred stock divided by the price of the preferred stock times 1 minus F, which represents the flotation costs. Flotation costs are commissions, legal expenses, fees, and any other costs to issue new securities. Here, the stock price is adjusted for the flotation cost, which is typically shown as a percentage of the stock. Therefore, the price times 1 minus 5% equals the price of the stock after the flotation cost, and the rate is calculated as 9%. Flotation costs for preferred stock are typically significant, so we always consider those in the net price. And preferred dividends are not deductible for tax purposes. Therefore, we do not adjust for taxes. And the nominal rate is used, not the periodic rate. So we need to take that into consideration when looking at the information that we're given. Is preferred stock more or less risky to investors than debt? Typically, it's more risky because the company is not required to pay dividends. However, the firm does want to pay dividends because there are serious consequences if they don't. Why is the yield on preferred stock lower than the rate? Because corporations typically own preferred stock and they can deduct up to 70% of those preferred dividends as non-taxable. Therefore, the yield on those is higher than the rate of return. BT means before yield, after T is after tax yield. Let's take a look. Here we're looking at the rate on the preferred stock after tax, which is the rate on which is 7.92%, compared to the before tax rate of 9%, compared to a bond with a before tax rate of 10% and an after tax rate of 6%. You can see that the rate on the preferred stock is higher after tax. There's two different ways to raise common equity: directly by issuing new shares of common stock, or by reinvesting their earnings that are not paid out, which is referred to as retained earnings. Why is there a cost for retained earnings? Because investors could buy other securities earning a return on those. Earnings can be reinvested or paid out as dividends. Typically, there's an opportunity cost if the earnings are reinvested, because stockholders could go earn an alternate rate on investments of equal risk, or they could buy other stock. Therefore, the rate on the other stock is the cost of reinvested earnings, and it's the cost of common equity. There are three different ways to calculate the cost of equity, which can be used interchangeably for common stock. The capital asset pricing model, 2, the dividend growth model, or 3, the own bond yield plus adjustment risk premium model. Let's look at the capital asset pricing model. Again, you might recognize this formula from Chapter 7. The RPM is the current risk premium. The RRF is the risk-free rate, and the beta, B, is equivalent to the stock's relevant risk. Said differently, it's the amount of risk the stock contributes to a well-diversified portfolio. The rate on cost of equity is the risk-free rate plus the market premium risk times the beta. Looking at the dividend growth cost of equity, again, it's using the formula that we used last chapter. It's looking at the rate equals dividend at time 1 divided by the current price plus the growth rate. If we don't know the dividend at time 1, we would calculate it by taking our current dividend times the growth rate. How do we figure out the growth rate? Well, we can estimate it using the historical growth rate if we believe that it's going to be similar to the past. We can obtain analyst estimates, or we can use the earnings retention model. Suppose the company has been earning 15% on equity. This is equivalent to the ROE, which is the return on equity, and has been paying out 62% of its earnings. That 62% is referred to as the payout ratio. The retention ratio would be 1 minus the payout ratio. Therefore, our growth from earnings equals the retention rate, which is 1 minus the payout ratio, times the ROE. You'll see that the 5.7% growth rate is equivalent to the 5.8% rate that we were given earlier. The own bond yield plus judgmental risk premium method is typically used for private companies. The rate is in line with 3 to 5%. And again, it's used when we have a private company or small business that isn't issuing debt. Isn't issuing capital. It produces a ballpark estimate. You would take the current rate plus a judgmental amount, typically between 3 and 5%, to calculate the rate on stock. A reasonable estimate would be the average of these, which is 12.8%, equivalent to the capital asset pricing model. How do we determine the weights that we use to calculate the WACC? It's the percentages of the firm that will be financed by each component. Whenever possible, we want to use the target capital structure weights, not the actual weights. We can use the actual weights when we don't know the targets, but we should be using the current market values rather than the book values. Finally, if we don't know the market values, then we can reasonably use the book values, especially when the debt is short term. Let's look at an example. Suppose the stock price is $50, there's 3 million shares of stock, 25 million in preferred stock, and 75 million of debt. The value of the stock is 50 times 3 million shares, 150 million. The value of the preferred stock is 25 million, and the value of the debt is 75 million. Therefore, the total value of capital is 250 million. We calculate the weightings for each. 60% is stock, 10% is preferred stock, and 30% is debt. Here's the WACC formula finally written out for you guys to see. You can see that it's taking the weighting of each component of capital times the required rate for that component of capital. And for debt, it's the after-tax required return. So what factors influence the company's WACC? There's two different types. Uncontrollable, which is tied to the market and market conditions and tax rates, and the controllable factors, which the company has control over in terms of their capital structure, dividend, and investment policy. Can we use the firm's WACC for each of its divisions? No. The firm's WACC reflects the average of all of their divisions. Each division has their own specific risk that we need to consider when calculating the WACC. We need to risk adjust for the divisional cost of capital. We look at that. We do that by looking at the division as if it were a standalone firm and then estimating the division's beta, cost of debt, and capital structure. How do we do that? We can look at public companies that are in line with the project's business, use an average of their betas as a proxy for the project betas. However, it's hard to do this. We can run a regression, or we can calculate the accounting beta. Alternatively, we can use the divisional cost of capital model, using the CAP model. Here's some information that's given for this company. We would take the division's required return on equity and calculate it as the risk-free rate plus the market risk premium minus the risk-free rate times the beta. This gives us a WACC for the division of 14.9%. The division's WACC is 14.9% versus the company WACC of 10.4%. Therefore, we would accept projects for this division if their returns are above 14.9%. There's 3 different types of project risk listed here. We would do the same thing. We would start by calculating the divisional cost of capital, and then we would scale up or down based on the individual project's risk relative to the divisional cost of capital. When we look at issuing new common stock, we typically have to pay flotation costs, which we talked about before. Therefore, if the flotation costs are significant, then we need to consider those in our calculation of the equity. Again, we would adjust the price of the stock for the flotation cost, as we saw earlier. We would do the same thing when calculating this for debt. Using a financial calculator or Excel, we would use these inputs to calculate the rate. The payment is the after-tax interest rate. Therefore, we're paying a coupon of 10% times the par of 1,000 times the tax, 1 minus the tax rate. The present value is the par times 1 minus the flotation cost of 2%. Here's some comments about flotation costs. They depend on the risk of the firm. They're highest for common equity. However, we will frequently ignore the flotation costs when calculating WACC if they're small. Here's some mistakes to avoid. You want to look at the current versus the historical cost of debt. You don't want to use current and historical measures. You want to stay consistent. You want to use the market weights versus book weights, and you want to avoid incorrectly calculating the cost of the capital components. Here's some more detail on this. You can peruse through the slides it posted in Engage. I'm not going to go through each of these. I will post the homework review on video at 7 p.m. on Monday with the assigned homework for the week at the end of that video. Please let me know if you have any questions on the material before then. Thank you.